This meeting is being recorded.
Have you ever wanted to be a fly on the wall and hear what Goldman Sachs has to say, what Goldman Sachs is telling their investment community? Well, folks, at One Rental at a Time, we are lucky enough to have someone with 10 years of Wall Street experience. He is in the boys club, and we're going to welcome Taylor from Life Goal Investments to tell us what Goldman Sachs is telling their Richie Rich clients. How you doing, buddy?
Doing great, doing great. Yeah, Goldman Sachs is the gold standard, right?
Absolutely. Yeah. Goldman Sachs is the best of the best. They've earned that year after year, decade after decade. And as all investment houses do, they talk about the year upcoming, right? We just flipped to 2023. So you got access to a insider's view or report on what they're telling their clients. So I'm curious, is Goldman Sachs a big fat bear? Are they a bull? Are they in the middle? Do they not like? What's Goldman Sachs telling their wealthy clients?
It's funny. It's funny that you asked, just because Goldman Sachs right now is talking about cuts and layoffs, right?
Yeah,
That's what's the
8%,
headline
right?
of the news. So
Yeah.
it's natural for you to say, okay, they're bearish, but they're not. They're actually incredibly bullish relative to what the street is, which was
Really?
a shock for me, because again, when you're talking about layoffs at your own company, you're talking out of both sides of your mouth almost. But their overall projections are positive. They expect a positive 1.8% GDP growth rate for the United States for 2023, which is far ahead of what most are saying at this point. They put a projection out that the recession likelihood, so obviously if they expect 1.8% GDP growth, they think that recession likelihood is low. They put it at 35%, which is just about half of what the street consensus is right now. Street consensus for economic outlook is about a 65% chance of recession coming here in 2023. So I was surprised by that. And again, especially when you see the headlines of Goldman laying people off, and then they come on the other side and say, hey, we're actually pretty darn optimistic. And we can get into some of the details as to why. But what, am I wrong in thinking that, hey, unemployment, or not unemployment, but job cuts coming for their own company, but yet we're optimistic? It sounds funny, right?
It absolutely does sound funny, and certainly to the novice investors, it's really interesting. So really, if not to put words in Goldman Sachs, I would not proclaim to have the right to do that. But what I think they're telling us, and maybe it's in the subtleties of the report, is they think the chances of a soft landing are pretty good.
Yes.
Yeah,
That's
yeah.
what they think is actually the most likely outcome.
That is their
And
base
again,
case.
that's their base case. Yeah. And I think you and I both disagree with that. We both have the opposite view, that the base case is we are in for a mild but potentially prolonged type of recession.
Yeah, and again, I think it will be shallow. But and again, let's also talk about, I think, at the macro level, which is where Goldman started, which I think is genius, right? They're calling GDP 1.8. You
Correct.
could have a recession, Q1, Q2, and still get 1.8 for the year. It's possible.
You could. It would have to be a pretty good boomerang back around, a pretty good bounce off the bottom to get negative start for the year from a GDP perspective, and then wind up being as positive as almost 2%.
Yeah, it's not probable, but possible.
Yeah, and when you think about 2%, I'm rounding 1.8 to 2%, but that's essentially pretty darn close to what long-term average is for GDP growth in the United States.
Yeah, that actually might be the long-term average.
Right, it's
Yeah.
right about there. Yeah, I think it's
Yeah.
just I want to say it's 2.3% is the long-term GDP growth rate in the United States. And so when they start broadening out their spectrum even further and looking out at the world at large, they believe right now that Europe and UK are in a recession at this point.
Have to be. They have to be.
Right. You know what's funny though, in talking about that, as we look at year-end numbers, for S&P type, ex-US type investing as well, you actually have better returns out of the ex-US market than you do the US market, which is really funny to say, right? Because the S&P
Oh no,
was
Peter
down.
Schiff is right. I got to be investing in the emerging markets. Oh no.
Yeah, yeah. So, and what it actually shows though is that the international market was here. Let me actually grab the real number here as I'm talking. But the international market again did actually a fairly significant amount better than what the S&P 500 did this year. And what that shows is, even though they're in a worse spot from an economic standpoint, when you look at the ex-US world at large. So the international stocks were down 16%, whereas the S&P 500 was down 18%. So I overstated there. Only a 2% difference there. But I think most people would argue that outside of the United States, the global at-large market is actually seeing a bigger economic slowdown than we have. We've dealt with it a little better than the world at large. Go ahead.
I wonder if this is just Goldman once again subtly reminding us that the stock market is a forward-leaning indicator, right? The world probably felt the pain first. They're going to come out of it first. I actually think that's pretty right on, right? I think Asia felt it first. Europe is feeling it now. We'll feel it next. Which again, if you play that analogy out, we went in last, we come out last. I think again, no certainties, but probabilities. I think that's reasonable assumption.
Yeah, and I think what you have to understand as an investor, especially in the stock market, is that you have to understand where valuations are. So valuations overseas were much cheaper than they were in the United States. You know, the price to earnings multiple was significantly cheaper, and it still is. But when you have a significantly cheaper price to earnings ratio, the compression isn't as much. You know, there isn't as much downside based on multiple compression, and that's why they saw a better performing year in 2022 than we did here in the United States. And
Okay.
so what was impressive as I dug into that report a little further is how Europe has dealt with the energy situation that's playing out. And obviously they're getting squeezed, and they have been squeezed from their dependency on Russia, and they're trying to get away from that dependency. And they've actually done a darn good job. They have reduced their energy dependence on Russia by 80%, 80%.
Wow.
Which I didn't realize how darn good of a job they have done, and they have benefited. They've had a relatively mild winter thus far, and that's certainly benefited because they have massive inflation in the European market, in the UK market, because of that energy reduction in dependency on Russia has driven up their energy costs so much. But yeah, so Goldman says, listen, they're in a recession right now. They're dealing with this energy, independence from Russia much better than what most have expected. And because of that, they actually think that they'll exit a recession here relatively quickly and come back and produce that positive GDP again.
Wow. Yeah. Again, you got to appreciate Goldman's thoughts. I appreciate you kind of sharing this with our audience, right? So macro US, macro world, do they come in and talk about kind of places to play and any upside surprises kind of maybe at the lower level?
Nope. So it's just a macro report in general. They do talk about what their expectations for the Fed are. They expect the Fed to take rates from 4.25 or 4.5 right now to 5 to 5.25 for the. So they, yeah, that's your number. That's your number.
And my number for 6 months, Goldman. Get your own number.
It has, to your credit. No, absolutely. Toot your own horn. Take a victory lap on that because you're right on there. And what they're saying there is that we'll see a 0.5% increase in unemployment. So they really have rosy numbers. So it's only a 0.5% increase in unemployment. And so they expect, again, inflation to come down pretty meaningfully. And with that, only a 0.5% increase in unemployment. So
let me summarize. I want to make sure I got this. So they're calling US GDP 1.8% for 2023.
Correct.
They're calling a Fed terminal rate, let's call it 5. And they're calling unemployment 4.2, 4.3.
Exactly right. You've got all those numbers exactly right.
Did they say CPI or inflation will be X by the end of the year? Was that in the report by chance?
I didn't see a specific inflation expectation, but they did talk, broadly that they think inflation is very well under control at this point. They think you're going to see job openings come down meaningfully. And they think that the Fed has obviously done a pretty masterful job here in kind of navigating this very tricky environment that they're in. And so Goldman is a huge, I mean, they don't come out and say this, but they're a huge fan of what Jay Powell's done.
Yeah. Yeah. So again, the of all of this, the one number I would watch, and thankfully we can get a little early indication every Thursday, is the weekly unemployment report.
Right.
That's what I'm going to be watching. Because again, if we can get through next year and unemployment stays sub 4.5, dude, I think a soft landing is the base case.
Yeah.
I think it starts to get crumbly at 5%, but sub 4.5, we're going to be okay, I think.
Yep. I think, I don't know. I think that's a little bit of rosy colored glasses. I don't actually anticipate that playing out. I think you get a little bit more of a meaningful pickup in unemployment. I think you don't get 50 basis points that Goldman expects. I think you get more like 100 basis points of pickup in unemployment. And I think that's kind of, Goldman is very optimistic on what the Fed has done. I think that the Fed is dead set on this. So I think that they're going to intentionally move unemployment. They talk at length about it at every single one of their press conferences and every single one of their written notices. And so I think that you're going to get a bigger pickup in unemployment than what has been articulated by Goldman in this report.
So folks, this is a macro opinion. Goldman Sachs, again, 1.8% GDP, terminal rate of 5 to 5.25, which really means 3 more increases, right? So that would be, again, I would guess Goldman's calling for 50 February 1st and 25 March 16th or whatever it is.
25, 25, 25.
Oh, they're going 3 in a row. Ooh,
yep.
Wow. Yeah, I'm calling 2 in a row and be done, but we shall see.
And so that's your call. Your call is 50 basis points next lap, 25 after that.
But 25, 25 done. That's
I'm sorry, 25, 25 done. Got it.
Yeah. So I'm calling 4.75 to 5. They're calling 5 to 5.25. Range. So they have 1 extra raise than me. But yeah, let us know what you think below. This is their macro call. Again, you start macro, then you make individual decisions. Folks, I'd love to hear from you. Taylor, you put a lot of amazing stuff on Instagram. What is your page?
Yeah, follow us at Life Goal Investments. Again, at Life Goal Investments. Appreciate letting us plug there.
Absolutely. Thanks, Taylor.